Hey everyone, welcome back to Corporate Decoder. Today, DAIO Corporation DAIO just filed their Q2 2026 report, and I am seeing some interesting shifts in their financials. Quick note, this is not financial advice, just my take on public filings for educational purposes. While sales are down, the company is seeing a big jump in gross margins, which tells a story about their strategy. This is DAIO Corporation's quarterly report, basically a financial checkup for the 3 months ending the 30th of June 2026. DAIO is a company that makes programming systems for electronics manufacturing, kind of like the tools that program chips in your phones and cars. Let's dive into the balance sheet. As of the 30th of June 2026, DAIO had about $24.6 million in total assets. That is up from $20.2 million at the end of 2025. Their cash position looks pretty healthy, standing at $10.8 million on the 30th of June 2026. This is a nice increase from $7.9 million at the end of 2025. Now, something notable here is the convertible debenture, which is a type of debt that can be turned into stock. It shows up as $6.2 million in current liabilities for June 2026. This was not present at the end of 2025, indicating a recent financing event. The number of outstanding common shares also jumped significantly from 9.4 million at the end of 2025 to over 10.4 million by June 2026. This often means the company has issued new stock, likely related to that convertible debenture or other equity events. Now, let's look at how they performed financially in terms of making money. For the 3 months ending the 30th of June 2026, net sales were $5.1 million. This is a decrease from $5.9 million in the same period last year. For the 6 months ending the 30th of June 2026, net sales were $8.4 million, a pretty big drop from $12.1 million in the first half of 2025. The cost to produce their goods also went down, from $3 million in the second quarter of last year to $2.2 million this year. And here is where things get interesting. Despite lower sales, their gross margin, which is the money left after paying for the stuff sold, actually improved. Gross margin as a percentage of sales was 57% in the second quarter of 2026, up from 49.8% in the same period last year. This is a strong improvement and suggests they are either selling at better prices or managing their production costs more effectively. Research and development expenses decreased, coming in at $1.4 million for the quarter, down from $1.7 million last year. This could be a sign of focusing R&D efforts or completing projects. However, selling, general, and administrative expenses went up. They were $2.3 million for the quarter, compared to $2.1 million last year. The report mentions this is largely due to one-time reorganization costs. A big change here is interest expense. It jumped to $873,000 for the quarter. This is because of the convertible debenture we saw on the balance sheet, which started accruing interest. All of this resulted in a net loss for the quarter of $1.6 million. That is a bit worse than the $742,000 loss in the same quarter last year. For the first half of the year, the net loss widened to $4.8 million compared to $1.1 million in the first half of 2025. Let's look at the cash flow to see how the company is managing its money. For the first 6 months of 2026, the company used $5.2 million in cash from its operations. This is a significant outflow, which is higher than the $233,000 used in the same period of 2025. This usually means the business is spending more cash than it is bringing in from its core activities. On the financing side, they brought in $6.8 million from issuing convertible debt, which is that debt we've been talking about. This section explains a private placement that happened on the 17th of June 2026. The company issued shares of common stock, convertible debentures, and warrants. They raised about $9 million in total. The convertible notes, which can be turned into Series B preferred stock, were issued with principal balances totaling $6.8 million. These notes mature in 5 years and carry a 4% interest rate. They can be converted into stock at a specific price. And they also issued warrants. These give the holder the right to buy shares of common stock at a set price, $3 per share. For the next 5 years, there are 1.08 million warrants in total. This type of financing with debt and warrants is common for companies looking to raise capital, but it can also signal financial pressure. Something important happened right after the quarter ended. On the 8th of July 2026, shareholders approved the terms of the notes. This triggered an automatic conversion of the outstanding notes into preferred stock. This is a big deal because it means the company no longer has that convertible debt burden, which is generally a positive step. Now let's get into what management has to say. They mentioned that sales momentum continued in the second quarter of 2026 and revenues recovered. They also highlight a positive mix shift, better pricing discipline, and improved overhead absorption, all contributing to better gross margins. They are still facing challenges from global trade and tariffs, but they are working to manage these issues by changing where they source materials and manufacture products. A major point is their announcement of a letter of intent for a strategic acquisition. This could really change things by bringing in new customers, improving manufacturing, and pushing them into a programming as a service model, which could provide more recurring revenue. They also made some strategic realignments in their operations in Redmond, which are expected to save costs and improve efficiency. This section talks about internal controls, which are the company's systems for making sure their financial reports are accurate. They are still dealing with a material weakness in their internal controls, specifically related to its systems and who has access to what. This is something to keep an eye on, as it means there is a higher risk of errors in their financial reporting. They are working on fixing it, but it will take time to prove it is fixed. Here, they list the risks the company faces. They highlight the growing reliance on systems and the increased risks that come with it, including cyber incidents. They also mention a targeted cyber incident they experienced in August 2025, which caused business disruptions and potential revenue loss. The company also provides some non-GAAP financial measures, which are ways of looking at their performance that are not strictly according to accounting rules. EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, was negative $665,000 for the quarter. Adjusted EBITDA, which excludes things like stock-based compensation, was negative $509,000. Both of these are losses, showing the company is not yet profitable on an operational basis. Looking at their financial health and ability to meet obligations, their working capital, which is current assets minus current liabilities, decreased to $10.7 million from $12.3 million at the end of 2025. This drop is mainly because of the money spent on reorganizing operations. Even though they received funds from the private placement, they believe they have enough cash to operate for at least the next year. However, they also mention that if they pursue major acquisitions or business development, they might need to raise more capital, which could be through selling more debt or stock. So, what is the big picture here? Data.io is facing a tough market with falling sales, and they are still losing money. However, they are making progress on controlling costs and improving their gross margins, which is a positive sign. The recent private placement and the conversion of debt into equity are crucial steps that seem to be strengthening their financial position. The announced acquisition could be a game changer, potentially shifting them towards a more stable, recurring revenue model, but the ongoing issues with cybersecurity and internal controls are definitely risks to watch. The risk I am watching is their ability to turn that improved gross margin into actual profit and whether the new acquisition will deliver on its promises. My biggest concern is the continued operating losses and the impact of those past cyber incidents. What I'm actually looking for is evidence that their cost-cutting and new business strategies can lead to sustainable profitability. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.